All right, hello and welcome to Camel Finance. I'm your boy Camel, and today we got to talk about China. Okay, we got to talk about China. We got to talk about what we're watching occur in China and whether or not we can use this as kind of like a crystal ball to see what is most probably going to happen in the rest of the world. Probably the US will be the next to go, and then everywhere else will follow. I never normally say this, but can you please like and subscribe and maybe even throw a comment down today? We are competing today with a lot of clickbait. If you scroll through YouTube, you'll see everyone has a thumbnail on fire. Everyone is talking about how the stock market's being halted and China's about to cause a recession and blah, 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 blah. So, since that's what we're competing with, can I just humbly ask you to help the algorithm out a little bit today? Next, as of yesterday, I touched again, it's not the first time I've done it, on my background and how I came to be a trader. And I had a lot of questions that were very similar. And they were along these lines, okay? Do I recommend any books? What to learn? If I was going to start again, what I would do, what I wouldn't do. So I thought I'd quickly touch on this, okay? Books, my approach to books has always been I never trusted them. I always had the approach of, if you are such a good stock trader or investor, why are you selling books? Okay, that was always my approach. I have come to learn later in life that's probably not the correct approach, but I can't really recommend books as I never went to books. I learned everything I learned through first-hand experience, building spreadsheets and studying online. A lot of people said, what do I learn? And my answer to that is absolutely everything. You must become a learning machine. I've written indicators here just as an example because indicators is a very good example of what I mean by learning absolutely everything, even if it doesn't seem necessary or applicable to you. As you probably know by now, I don't use any indicators, but I understand all of them far, far greater than most people that actually do use them in their trading strategies. Okay, I understand how the mathematical code works. I understand how to modify them. I understand the requirement to modify them depending on the instrument you're trading. Not many people know this, right? If you use an RSI, for example, most people slap an RSI on and they say you got to sell when it goes above 70 and buy when it's below 30. And they don't realize that you're supposed to go into the code and change that value, which is 14. You're supposed to change that depending on the market that you use. You need to sharpen it or blunt it depending on what market you use. Almost nobody knows this, okay? The other thing is, just because it's at 70, people think it's time to look for sells. Not necessarily. What that actually shows you is the relative momentum in the market is higher than it has been in a long time, and thus you could likely expect the thing to continue higher. Again, people don't really know what they're talking about when it comes to indicators. So, as an example, okay, learn absolutely everything you can about absolutely everything you can, just like I did with indicators. The reason I don't use indicators is because I have understood them at the deepest level that I possibly could. Once I attained the understanding of indicators that I have, I decided they were no longer for me. That does not mean you shouldn't use indicators. That does not mean they won't work for you. It just, as an example, what to learn. Learn absolutely everything, even if it seems irrelevant. So what would I do differently? The number one thing I would do differently is I would have started with a practice account. Okay, especially if you're brand new. Now, if you've been around for a while and you maybe just need to work on your risk management, or maybe you are making money, you just have a habit of, every once in a while you jump the gun or you don't stick to your strategy and then you have to pay for that. Well, if you're in that category of traders, then perhaps all you really need to do is a little bit of introspective work, look at your trading results, figure out what it is that you do. Is it you're always drunk when you pull the trigger and that's what leads to the biggest losses? Is it that everything's going good for a while and then what you end up doing is getting overconfident, and that overconfidence leads to you adding more leverage or more size, and that is what's poking holes in your account? So maybe that's what you need to do, right? But if you're brand new to this, then at least for me, I blew 3 accounts up in the early days, and that cost me in the neighborhood of £20,000. Now, if I had more money, it would have cost me more than £20,000, and if I had less money, I guess it would have cost me less. But the point is, if I was going to go back and do this whole thing over again, I would have just used a practice account until I had doubled or tripled that account and felt absolutely confident in what I was doing. So if you are brand new, that is my number one piece of advice. Go back and do it with a paper account until you can consistently hit trades on a paper account. When you can do that, then you can move to funding it with real money. I don't regret what I did because I just look at that as paying a university degree to the market. I've paid my tuition to the market by blowing up 3 accounts, and that's fine. But in hindsight, if somebody had just said to me, hey, Camel, use a practice account for the first few years, then I could have saved myself that money, right? So that leads me on to what I wouldn't do if I was going to go back and do it again. I'll tell you what I wouldn't do. I wouldn't rush, okay? A lot of people have this idea that, well, I'm just going to trade irresponsibly long at the moment. I've got a smaller account, maybe it's a £1,000, £2,000, £3,000 account. I just need to get that up to 10,000. And then once I'm at 10,000, then I'll start to manage risk, right? But all you're doing with this approach is you are training bad habits. You're training the ability to just go way too big. You're training yourself to not manage risk, to not size your positions and your stop losses responsibly 100% of the time. And all that means is even if you get lucky, right? Even if you go big when you've got a smaller account, you quickly grow it into a larger account. All that means is now you've got more money to lose and you've trained that bad habit of going big, right? So if you can't respect risk and trade responsibly on a smaller account, you are never going to manage to hold on to a larger account. So what I wouldn't do, I wouldn't rush, okay? I would understand that if I only had a small amount of starting capital, then it's going to take me a couple of years to grow that into a reasonable amount of capital. But by the time I've done that, I will have trained responsible risk management. I would have trained good habits, and thus I'll be ready to play on the bigger tables. Worth pointing out here, if you think you can rush your way up and then start to manage risk, you're just going to end up putting more years in front of you that you have to put in the grind. Because all you're going to do, like I said, even if you do well, is train bad habits, blow up a larger account, and then you're going to have to start from scratch all over again. You're probably going to be in even more of a rush since, now I've already gone back to zero. I've got to hurry up and get back there. This is kind of a gambling mentality, right? You're probably realizing as I'm saying this, it sounds an awful lot like I've got a gambling problem in this hypothetical scenario. So don't do that. Take your time. Don't be one of these people that goes, oh, well, it's only a small amount of profit. I should have traded bigger. I could have had more. Don't do that. Train the good habits. And before you know it, you will have the size that you always dreamed of. But the only way you get that size is to be responsible and patient. And last but not least, I think every investor and trader needs to become a learning machine. These aren't my words. I've stolen these, and it might be from Buffett or Munger or somebody along those lines. These aren't my words, but all investors and traders must become learning machines. If you don't like learning, then trading's not really for you. Even to this day, I am still studying. Currently, I'm studying Elliott Wave. To tell you the absolute truth, I don't need Elliott Wave, okay? But I'm still studying it because I'm unfamiliar with it, and I always have to find something to learn. I'm also studying a different type of cycle at the moment, economic cycles, and I possibly am going to have some content coming out on that, but I'm still familiarizing myself with it. And outside of trading, I'm currently studying some chicanery, let's call it, that lies within the music industry, just to make sure I'm aware of some of the things that go on in this world. Far beyond the remit of this channel, but just to let you know, right? Even though I could easily sit back up, feet on the desk and trade, I still force myself to do study every single day because this is what it takes, right? This is what it takes. And for all we know, Elliott Wave is going to prove to be far superior to what I currently use, and perhaps in the future I swap to Elliott Wave. I highly doubt I will, but as something that I kind of avoided for many, many years, I am now looking into it again. So I hope that answers the questions for the newer people in the room, and for the more experienced, I hope you at least found some value from that. So without further ado, let's get into today. So of course, the big thing at the moment is 30% of all stocks in China have been halted as China's CSI 1000 index slides 8% in a matter of hours. So they continue to slide, and this continues to seemingly get worse and worse. I put this out yesterday and I said, look, China, remember, slipped into deflation in December. So again, if you've been on this channel, you're familiar with the work, then you know what I'm talking about. If not, maybe go back and watch the video from Saturday, the weekend deep dive. You'll probably need that as context. But for everyone else, right, China slipped into deflation in December. So here we are, a little over a month or so later, and the Chinese stock market has lost $1 trillion in value in 13 trading days. Kind of feeds into this narrative of the deflationary bust, right? Meanwhile, Trueflation is not giving me the dashboard, but luckily for me and everyone else, I screenshotted this yesterday. I said, look, I'm just going to leave this here below that post I just showed you regarding China. We had a 1.4 handle as of yesterday, and undeniably, this is starting to drop rapidly at the hard right edge, isn't it? Speaks to that inflation to deflation pendulum we've often been talking about. Also speaks to the fact that deflation may well be rapidly approaching in the US. As if that's not enough, one of the channel OGs brought this to my attention, and this is pretty interesting as well. Look, the money supply is officially contracting, and it's only ever happened 4 previous times in the last 150 years. Each time a depression with double-digit unemployment rates followed. So this is what I was talking about. You know, this is that chart. Remember the chart that shows M2 rate of change? And as I've said multiple times, we had a leg down, a sideways wobble, and a leg down. And that has corresponded with an 18-month lag to this, the leg down, the sideways wobble, and now the leg down. Now, as we enter the final leg down, right, we're starting to see this. We're starting to see this right here. Again, the last time this happened, we had the 1870s depression with an unemployment rate of 14%, the panic of 1893, that is, 18% unemployment, 11% unemployment during the 1921 depression, and 25% unemployment during the Great Depression. So based on everything I've seen, based on everything we've been going over for months, it's only reasonable for me, until at least I'm proven wrong on this, to expect this to continue down somewhere into this neighborhood before a reversal as always. And I do expect to see unemployment raise significantly over the coming 6 to 12 months. So in the meantime, my interpretation of this is slightly different to the majority of people I've been watching on YouTube. I don't typically follow a bunch of YouTubers, but this morning I had to have a look because I saw so many of these clickbait titles and I wanted to see if they had clocked what I had clocked and what we've been talking about for a while, or whether they were just doom posting. And I've kind of come to the conclusion that they're half right, okay? Yes, this is not something to be ignored. This is significant what's going on, but most of them are talking about how this is probably going to be a contagion, right? How this is probably going to spread and the rest of the world has to follow. I would make the argument that they're just a few months ahead, okay? Now, you could maybe say that's the same thing, I don't know, but I don't believe that we're just suddenly going to see huge stock market crashes and enter this recession prematurely. I don't really believe that happens. I still stand by the original hypothesis that we get the blow off top, that there's still space to run. And I think more of what we're seeing is a quick glimpse into the future, right? We saw China enter deflation, and then a couple of months later, China's stock market starts to plunge. Now, in the US, we are on our way to deflation, but we're not yet there. So I still think that there's time for us to get to deflation. In the meantime, though, we're going to see, lower CPI prints. We're going to see more disinflation, and the market is going to interpret that as the Fed has more wiggle room and has started to get inflation under control. So during that Goldilocks period, there is still time to see the market rally before, of course, deflation sets in. And then once we get to deflation, assuming we actually get it, which I'm pretty sure we will, once we actually get there, then we kind of have already seen what's going to happen, right? Around a month later, we could probably expect things to start getting pretty heavy, just like they have done in China. As always, there are complexities because this is March's FOMC meeting. And as it stands right now, we are a whopping 83.5% probability that we remain paused. So cuts have been taken off the table for March. And is this necessarily a bad thing? No, because we know that based on historical data, the moment they start the cutting cycle, the stock market typically tops between 0 and 2 months later. So the further they push these back, the more time we have to put in the blow off top and the more time we have for Bitcoin to catch up. That is the thing I want to see. I want to see Bitcoin catch up, because if we start to tumble down and the stock market starts to crash in the near future, Bitcoin likely won't exceed its all-time high. So this is good for now. I would rather be wrong about the timing of the cuts and see Bitcoin do better and the stock market go higher than be right about this and have everything tumble down faster. What's even more interesting is if we click out to May. Look, 36.7% probability that we remain paused in May. So slowly but surely, they're taking these cuts off the table, okay? In fact, not even slowly but surely. This is quite a significant and rapid repricing, if we're honest about it. But there is still, of course, scope to see this reprice the other way, since we know that inflation is coming down rapidly. This CPI print, which is due in about a week, I think it's the 13th it's due out, the CPI print for the US, is almost certainly going to have a 2 in front of it. And quite possibly, based on trueflation metrics, if it's anywhere close to trueflation, it's going to be in the low 2s, maybe 2.4, 2.3, something like that, if it's close to trueflation. Trueflation usually significantly below. But either way, we are going to get a 2 on the front of that CPI print. And when we do, suddenly these rate cuts are going to be put back on the table for March. I think they're going to be, with near certainty, priced back in for May's meeting. And again, that tells us that the end, or at least the top for the stock market, is not too many months away now. One last point to make on this. If this continues at this rate, right, if CPI continues to drop at this rate and it's indeed priced in the official US government reported level, then we are going to be at 0% as early as March or April. And therefore, if China is anything to go by, we're going to be crashing in the stock market by May or June at the latest. And then does that feed into the narrative that I've been perpetrating the whole time, which is that the Fed will be forced to cut because something is broken rather than cut voluntarily. So what a time to be alive. Of course, as I've been saying over and over again, we've got to wait until we see the CPI print. Once we see the CPI print, we'll get a true idea of what's going to happen pertaining to the cuts. And from there, we should hopefully be able to navigate the stocks and risk, such as Bitcoin, much easier. This chart is doing the rounds in other news, and this is allegedly defying logic. I don't think it's defying logic. I think this chart is somewhat of a LARPS chart. And I say that because notice how this scales in log and this one isn't, okay? So I guess you've got to make it fit your narrative somehow. The thing that I think we can take away from this chart is notice how the top comes in here in the red, okay? This is the Conference Board US Leading Index 10 Economic Indicators. Notice how that comes in here and the stock market continues higher for a while. But back in 2008, the top came in here and the stock market continued higher for a while. So it's not dissimilar. According to this chart, this is more severe than it was back here in terms of the divergence. But overall, that does not mean we can't continue to see higher highs put in the short to medium term. I've left total 3 here as a note to myself because somebody keeps asking me, or quite a few of you I think actually, keep asking me to cover total 3. So let's do that now. So here's total 3. I should probably preface this by saying I'm not an altcoin guy. I don't really care for altcoins. But when I was having a look at this chart as requested, the first thing I saw when I saw this was I was like, wait, I've seen this before. This is Wyckoff accumulation, and it looks to be completing the sign of strength before the breakout to phase E. So then I grabbed myself one of these and I was going to overlay it for you. So let's do that now. And you can see using the magic of TradingView, this is pretty much what we're doing, right? We have pretty much got a Wyckoff accumulation with no spring. Sometimes you get a spring that does something like this and then bounces back. Apparently we haven't got a spring, that's fine. That's why this is schematic 2. Schematic 1 has the spring in it. And what more is there to say, really? Apart from, if this is a bull flag that breaks out to the upside, we should expect phase E to be confirmed. We should expect, therefore, markup, and thus your altcoins should do pretty well. So, like I said at the start, I'm not an altcoin guy. I don't really care for altcoins. That's fine. You do you. But there's nothing more to say, really, apart from the fact that this is one of the most textbook examples of Wyckoff accumulation I have ever seen in my life. So I hope that answers your question. That's what I think of total 3. That's all there is to say. In terms of the other charts, it looks like we're doing our second idea, doesn't it? So our first idea was hopefully that we get that breakdown, but since then we've recovered. Our second idea was that perhaps we'll get a deviation into CPI, followed by that rollover, and thus the best we could hope for is that the 3-year cycle low forms down here. And of course, the more we move higher, the more likely it is that we are going to possibly have to entertain something like this. And if that's the case, then the 3-year cycle low is in. And unfortunately, times could be getting pretty rough at the moment. Now, perhaps this is me married to a bias. I'm still kind of leaning on the idea that we move into CPI around the 13th, and then the CPI comes in much lower than expected and the dollar sells off. That is my idea. But invalidation for this comes from if we get to CPI and we don't get this play out, if we get to CPI and we hold this level, right, at 104 and change, 104 and a half, say, if we do something like this and then continue higher, then I'm going to have to hold my hands up and say that this is flat wrong. Bitcoin, look, Bitcoin is refusing to break higher or lower, right? It's consolidating, it's squeezing. The cycles tell us there's one more quick wick down, okay? That's what the cycles tell us. But if it was to resume out of here, then we can just accept that the thing is more bullish than most people are ready for. So let's see. Currently, for this cycle, we are on day 57. So 60 plus or minus 6 days, and that would be a perfect cycle low. Are we going to get that pullback or not? That's to be determined. But so far, I'm sticking with the plan, right? What is the point in FOMOing in here when, I've been patient all the way through? So going to continue to play patient. The miners and the crypto-related equities are kind of feeding into this narrative, right? Cycle low, low, counter trend bounce, pull down into that cycle low timing window. So this is not telling me that Bitcoin knows what it's talking about. This is telling me that the crypto related equities believe a cycle low is coming as well, right? If this was to have done this and broken out here, then we could say, okay, the crypto related equities are confirming that we've got an early cycle low for Bitcoin, but they're not, are they? This is exactly the shape I was expecting to see out of the crypto related equities and Bitcoin. So because we haven't seen it from Bitcoin yet, but we are seeing it confirming the crypto related equities, that kind of tells me one more dip is possibly coming for Bitcoin. Kind of the same shape for MicroStrategy, right? Counter trend bounce, a little bit of a pullback. So I wonder if we can get one final undercut, or if this thing's going to start to break out, then again, that will be a sign of relative strength. Riot getting that same sort of shape and follow through, as is Marathon. So like I said, the crypto related equities are doing what we'd expect them to do. We just need Bitcoin to follow suit now. And if we can get one kind of flush and a reverse, I'm sure that will trap a lot of shorts. And of course, we'll know it's a cycle low, and thus we can start to add positions. So overall, patience seems to have been the right strategy, and we'll continue with that. The stock market's all still holding support, aren't they? So not really the end of the world. Lose those, and we will, of course, be locking in some profit. The VIX as well, not really giving a, a rat's tail. Sometimes I say the stupidest things. I don't even know. I've never said that before in my life. What does that even mean? You get the point though, right? Like, if the market doesn't care, why should I? And whilst all of these YouTubers are doom posting and everything's on fire in the thumbnails, right? Look at the VIX. The VIX doesn't care. The charts don't care. So I don't care. However, something I do care about is the Russell 2K putting in a warning sign, right? A trend line breakdown. This is not something I wanted to see with the lower high for the Russell. What I wanted to see was this continue up here, like my yellow squiggle suggested. So undeniably, this is a warning sign. I will hope to see this thing resolve to the upside, back above this upward sloping red support line into the end of this week. Oil looks to be working on that daily cycle low, so I expect a bounce here and then hopefully a left translated cycle, meaning the top for this next daily cycle comes before day 20 of a typical 40-day cycle for oil. If we can get that left translation and a rollover, then I think we can re-enter our short and we're going to be targeting much lower down. I know, very hated trade, but that's the way I like it. Still playing patient on gold. We'll see which one of these yellow paths we take, and then we'll be looking for a short entry. Of course, for all the members, we are hunting for those minor positions. So I want to get back to you as soon as I have something to say. Sit tight in the meantime. I will be putting out deep dive and a detailed video as and when the positions are ready to take. But as you can see, we need to look for swings first and then confirming with trendline breaks. For everyone else, I hope you're doing well in life. And until next time, take care from me. All the best. Cheers. Bye.